Welcome to the Get Real Podcast, your high-octane boost of in the trenches, tell it like it is reality therapy for personal, business, and real estate investing success. With your hosts, powerpreneurs, Angela Thomas and Ron Phillips. It's time to get real.
Hey everybody, welcome back to another episode of the Get Real Podcast. I am Ron Phillips. Man, I say it every time, we got a great show today. I think you guys are going to learn a ton. I've got Joe McBreen with us from Cross Country Mortgage. Who doesn't want to know what in the hell is going on with the mortgage industry, and who better than somebody who's been in the business for 2 decades, and between him and his wife is 4 decades of experience, and their company's been around since 2003. They've been doing this through the downturn. And I point that out because I've been doing this since 2005. I made it through the downturn. And as Joe, you can probably attest, welcome to the show, by the way.
Thank you.
People who were in our industry, whether they were actually on the real estate side or the mortgage side, and somehow were able to make it through 08, 09 and prosper, it's a very small club. So yeah, man, I'm excited to hear from you because of that type of experience. That's remarkable in our world. So tell us a little bit about your company. It's been around since 2003, but you've been doing this for a long, long time. Talk a little bit about your company and how you guys may be different than other mortgage brokerages or things like that out in the world.
Well, first of all, we're a privately held mortgage company, one owner, if you like. I think established in 2003. Maggie and I and our team just joined them about 2 years ago. But as you said, we've been in the business for quite some time. We've been concentrating on the investment property turnkey stuff for about 7 years and have built that up into being kind of a national leader in turnkey financing. Our company is a correspondent lender, which means that we have delegated underwriting authority with Fannie Mae and Freddie Mac, particularly for our investment property stuff. And that means we originate, process, underwrite, close, and fund all of our own loans, and then deliver those loans for servicing to a servicer. But we typically keep our investment property servicing in-house. So for a client like who may have purchasing multiple properties at the same time or adding to their portfolio, using one lender and having one servicer service all their loans is very important for that individual borrower to manage that mortgage payment on each property.
Yeah, it certainly makes it a lot easier. And
that's a little bit unique compared to other lenders. Most lenders will just deliver servicing post-closing and you really don't know where it's going. So we're lucky that we have the advantage to direct at least our investment property stuff into our in-house servicer.
So tell everybody, how is that different? I mean, that all sounds really great, but how is that different and unique, not necessarily the servicing, but that entire process than a traditional mortgage broker, right? So I go out and I find a mortgage broker who doesn't have all of what you just said.
Right.
How does a transaction different, and why is it important to have the whole process in place that you guys have?
Yeah. So if you look at banks, correspondent lenders, and brokers, your bank loan officer is typically going to sell just the bank product. That bank may only deal with Fannie Mae or Freddie Mac or both. It may concentrate on jumbo loans and only do a lot of jumbo loans. A lot of banks recently kind of shied away from government loans, FHA and VA lending. A broker will do all of that. However, they originate the loan and then they deliver that loan paperwork or documentation, if you like, on the loan to that lender, and they underwrite the loan and they fund the loan and they manage the closing of the loan. With us as a correspondent lender, we would have access to a lot of different lenders or products, all of the big banks, all of the portfolio lenders, and then we can choose and get the best rates from each one on a daily basis. But then we manage the process. We have 5 girls on our team, which just Maggie and I, who help process all of our individual loans. But as a company, each lender, each loan officer would have designated processing support and underwriting support. we would have 2 underwriters that underwrite our production each month. So we get a lot more control over the execution of the loan. And then we control the closing and funding, and then obviously delivering for servicing. So that's a little bit more unique. What's also different is most banks or lenders will set their own credit overlays on top of, let's say, Fannie and Freddie's guidelines.
Right.
But we're a direct lender to Fannie and Freddie, so we don't put overlays on top of their guidelines. We just follow their guidelines, and we deliver our loans to those individual investors, like based on how they want the loans delivered. So when we as a delegated underwriter, we're just following those guidelines. We're not setting another layer of risk guidelines on top of that. And that might mean in the investment property world, that might mean, they limit the number of homes a guy can finance to 4 or 6, whereas Fannie and Freddie will allow you to finance up to 10.
Right.
Another overlay, maybe they limit your credit score to 660 minimum. Fannie and Freddie will go 620. So we can expand our production, if you like, based on the base guidelines from Fannie and Freddie and not overlays from another lender.
Yeah, that's really big. And that whole processing and having your in-house underwriters and funding your own loans, that is a massive benefit and a huge separator between a traditional mortgage broker and not. And Joe, we've been doing this a long time. We've sold thousands of properties, and we've broken more mortgage brokers than we haven't.
Right.
And it's for that reason. It's because they don't have literally any control. The underwriters are not in-house. They don't know what they're doing. And the mortgage broker, bless their heart, thinks they can do things they can't do. I was just talking to Heather about this yesterday because we had a client who wanted to go and find their own mortgage broker because the fees were a little bit less. It might have even been with their local bank. And I'm like, this is going to blow up. This is going to blow up because they think they can do something that they're not going to know they can't do until it gets all the way to the end. And the underwriter goes, yeah, this doesn't work. You can't do this. Yeah. Not at those rates, not at those fees, not at all. Can't do it. Right.
I mean, to your point, most of us have very similar rates, very similar fees. We're in a very competitive world. It's all about execution. You get what you pay for, that old saying, but in some instances with the expertise that we have in the investment property world, we get separated from the other lenders on another level as well with our appraisal panel.
Yes.
Most of our turnkey partners in most of the relevant markets that we're in will know kind of who the appraisers are. They're familiar with the appraisers that are familiar with how they purchase the homes, remodel the homes, sell the homes for profit. Let's face it, nobody's a non-for-profit. But the appraisers would be familiar with the work that they do. So for us, it's important that we create appraisal panels through our appraisal management company in each market so that while we don't direct appraisal orders, they do go on a round robin to a set number of appraisers in that market who are familiar with the turnkey model. If you were looking at a bank or a credit union or anything like that, they would, just farm the order out to whoever picks it up for the cheapest execution, and then they go out and do it. And they may not ask the right questions of the turnkey provider. They may look for comps just on the MLS. They may not look for comps from the turnkey provider who doesn't put their homes on the MLS and has the demand to purchase those homes without going on the MLS. So
it's literally Russian roulette with appraisers. That's literally what it is.
So that's another big separator for us.
Let's go back to something you said, because I think it's this is something that unless you're in the business and unless you understand, this is something where people can pull the wool over, your average person out there who doesn't understand this process. They can really play games with numbers. So let's actually break this down and give some people what they need to be asking to get an apples to apples comparison, because you and I both know that the par rates are not that much different, right?
Mm-hmm.
It's what you do with the fees and how you play games with the rate. Some people will say, well, but this guy's giving me a really crazy rate. Yeah, but he's charging you 2 points. He's charging you 2.5 points or 3 points because he's buying the rate down, and people don't understand how this works. Give us a real quick overview of how that game is played and the right questions to ask so that you can get a real apples to apples comparison.
Well, I think from a basic level, the question is, what is my rate based on my individual characteristics, my credit score, my down payment, the property type, and the loan size at the par level without points, right? Now, the par level, the par rate that we get is a rate that's already set by the company based on the company's corporate objective. Again, let's face it, it's not a not-for-profit, so there is some, execution there that needs, and there's shareholders or, dividends to be paid or whatnot. So, but that par rate is typically very competitive among lenders. Some companies will have a different corporate objective over others, and that may be the difference in the rate of 1/8 of a point up or down on any given day. Lenders will also charge in terms of fees. They might say, oh, this is my lender fee. But then on top of that, they have a processing fee. They have a credit report fee. They have flood certificate. They have a tax service fee. They may even have a loan level price adjustment fee. And all of a sudden you're paying $1,600, $1,800 in fees, but you think your lender fee is like $700, right? Because it's part of that process, or it's put in a different spot on the closing disclosure. So for us, we just charge a flat fee regardless of loan size of $1,295. Now, when we're doing multiple deals for a client, we get some economies of scale with processing the paperwork, with underwriting the file, because all three would go to our underwriter at the same time. So then we can, as an individual loan officer, or Maggie can just reduce our fee. Okay, we'll apply a lender credit. So we're very conscious of that when we're doing multiple deals simultaneously for one client, or return clients. If it's a refinance, we're always trying to reduce the fee that the lender charges. But the third-party fees are what they are. The appraisal fee, the title and recording fees, the credit report fee to a degree are all third-party and are charged per loan, per deal. So
what I'm hearing you say is, what people need to do when they're trying to compare apples to apples is all the lenders that they're shopping, right? So if they're shopping 2 lenders or 3 lenders, what they need to do is they need to say, okay, pull my credit or give them the credit report, whatever, right? So they have, this is really who I am.
Yeah.
And then the down payments on all of these need to be the same. So sometimes another trick they'll play is that you can get a significantly lower rate. Well, significantly, you can get a markedly lower rate by putting 25% down instead of 20% down. Yeah. And sometimes they'll play games with those. What you want is you want to say, I want all of these at 20% down. I want them all the same. I want them at a par rate, your par rate with no fees. And then I want a list of every single fee you're going to charge me, all of them.
Yeah.
And I want them very clear so that I can see them. And this is the loan amount that I want you to do it for, right? And then you can very clearly see between these lenders what it really is. And that's really, really important. And the next thing is, how quickly can you close this loan?
Yeah, the execution of the loan is tremendous.
It's really, really important, because if you're talking 1/8 of a point and somebody can close a loan for sure in 30 days or less, and you have contracted to close in that time frame, it's the difference. That 1/8 of a point could be the difference between you actually losing a deal, losing your earnest money, losing the fee for the appraisal, losing the fee for the inspection, and everything else you've done over 1/8 of a point, when you can have somebody who will absolutely execute in that time frame. It's really, really critical, and I think it's something that's overlooked by the penny pinching type out there, right? So if the fees are close, if the rates are close, and one person has a tremendous background of execution, man, every time I would err on the side of execution over saving 1/8 of a point.
Yeah, and it's not that we're out of the market in rate and fee. We're very competitive. And we do
yes, I can attest to that. I'm saying as an apples to apples comparison, I think sometimes people get
they just get confused sometimes on the fees, or they add them up and it seems lower or cheaper, or they don't understand the points like you mentioned. So for us, with our volume, the execution is the key part of it. We set the expectation. internally with our team and with our clients up front that, while this may be your first investment property, we're going to close, and regardless of the loan size, we're going to close on that and we're going to execute that loan like we normally would for a seasoned investor or buyer.
Right.
So what that means is, for a novice purchaser or investor who, has a lot of questions or we need to set the expectation up front like we would for every single borrower. So that's what we do. That's our goal. I tell my team, listen, if we close 50 loans a month, the expectation is we should be good at it. And, we have to set that expectation for the client that we are good at it. And that, if you go and choose another lender who doesn't understand the turnkey model, who doesn't understand the processes involved, such as the appraisal and things of that nature, and documenting the scope of work, then you may run into that situation where you're 3 weeks down into the loan application and you get a denial, or you run into a problem that would not have been.
And then you can't catch up. We
would have foreseen any problems in the beginning. We would have addressed.
Joe, here's another thing that we forgot, because a lot of times another trick these other lenders will play is they'll quote them a second home. And, when you're buying a home that's vacant, you might be able to get away with the fact that you were buying it as a second home and then you decided not to after the fact. But when you're buying a house that has a tenant in place, that does not fly. You cannot think that you can buy, and if you do, that's called mortgage fraud, because you did not intend that to be a second home. Very clearly, you have a year lease on the property. It's obviously an investment property.
And we do a lot of due diligence. We'll see if it's on the market. We'll see if it's leased. We'll see. Most second homes that we will finance, there has to be a really good reason for it being a second home. Like, is it in a destination point? Is it on a lake? Is it on a beach? Is it geographically, does it make sense from the borrower's primary residence?
Right.
Purchasing a second home in the same town that you live in, and that's not going to fly necessarily with an underwriter.
And let's just be real, Joe. I mean, nobody's vacationing to, sunny Indianapolis or, wherever the case. I mean, most people are not doing that.
Yeah, I mean, there is some validity. There's some validity in some cases where, it might be an hour and a half commute to the suburbs from downtown, like Chicago, where we're based.
Yeah.
A client may have a condo in the city, a small one-bedroom in the city to work in during the week and live in during the week. So that makes sense. But if you're buying a home in, central rural Alabama and you live in LA, it's hard to document or convince an underwriter that you're going there, every month or every other month for
I've been to Alabama. There's some really nice places in Central.
No, I'm just picking that state.
I wouldn't vacation there though, Joe. I'm sorry, I wouldn't vacation there. I'm sorry, all you people from Alabama. I'm not vacationing in Central Alabama.
Yeah, no offense. Just an example.
Yeah, no offense. I'm from Kansas City, and I wouldn't vacation there either. So let's talk a little bit about like the state of the market, and I don't want to get too crazy on what it is today, but what I would like to do is help people understand what the heck, like, some people hear that it's tied to the bond market. Some people, I have a lot of people who hear that interest rates, they've been lowered and lowered and lowered, and now they're, either zero or approaching zero. And investor loan rates are still, mid fours or, somewhere around there. Right. And people don't understand why this is. And they also don't understand why it is that, they can go get a loan on their home for sub 4, even on a jumbo loan, but they can't do, an investor loan is more expensive. Help us unwind why all of that stuff is.
So, I mean, obviously we get this question every day, especially in the current environment or climate that we find ourselves in. But in a normal market, to a degree, you're right. As the Fed fund rate goes towards zero and currently is at zero, the prime rate is at a floor of 3.25. So typically mortgage rates would follow. The 10-year note would follow suit, the 10-year bond. So as the 10-year bond goes down towards zero or under 1, I can't remember where it's currently trading at the moment, but in a normal market, you will see mortgage-backed securities and mortgage bonds kind of follow that lead, follow the treasury lead as it goes down or up. Now, in this instance, in the climate that we're in now, it's a little bit of an anomaly because mortgage-backed securities at the higher levels for investment properties, if you think about an investment property, it has an inherent layer of risk anyway over your primary residence. That risk being, the vacancy factors, the fact that it is an investment property with 20 or 25% down makes the difference in rate sometimes. But currently, those coupons are trading at a higher level and nobody's buying those mortgage-backed securities right now. The Fed currently is buying quite a good level of mortgage-backed securities at the lower coupons, which relates to your primary home loans and your second home loans. Mm-hmm. So today you're seeing that market quite stable and quite good and relatively in line with how it normally would be trading based on where the 10-year note is, right, and where the yield is. So that market is quite stable and it's acting pretty normally. The investment property market, outside of that inherent, risk layer or perception of risk that you normally see, with COVID and the current climate we're in, you see that being elevated a little bit more, because of forbearance and, tenants given a short-term moratorium on not paying rent and being, forgiven from being evicted, if you like. Now, again, I believe that's a short-term moratorium. And at some point in either that case or the forbearance case, you're kicking the can down the beach, and at some point you're going to make it up. So you're seeing an inherent layer of risk there on an investment property, 20% down, that is probably a little bit more elevated than it normally is. With 25% down on investment property, you're seeing pretty good rates, pretty normal rates there because you've got more equity into that property. The layering of risk is a little bit less. The perception of that risk is a little bit less because you've got more into the deal. So that's acting a little bit more normally as it relates to where the current market is and the treasuries are, okay, and where the Fed fund rate is. So in essence, I think we're just seeing an elevated market at the moment for whatever perception of risk there is and that elevated perception of risk, because what they're feeling is that any loan that goes into forbearance, temporary 90 days or 6 months or 120 days on a payment plan, at some point, some of those folks are not going to go back to work and some of those loans will go into default, right? Yep. So who wants to buy a loan that's going to go into default if you're an investor? So they're layering that risk. They're adding to that risk. And part of that is including price adjustments to the rate.
Gotcha.
So that's kind of in a nutshell, kind of basically and simply how it's working at the moment. I believe that as we turn the numbers on COVID, as we come up maybe with a vaccine or the national testing models, scaling that, you'll see the market and shelter in place be lifted across the country, and a lot of the unemployment figures that we're seeing now will dramatically decrease. People will go back to work, and we hope that the market will react more normally to the recessionary environment that we're in general. Because when you shut down entire industries, they don't bounce back just because shelter in place is lifted. So I believe we're going to be in a recessionary environment for, at least a year, maybe 2. And as people go back to work, we should see mortgage rates react more normally to where the treasuries are trading and where the Fed fund rate is. Because even though the Fed is meeting this week, they're not going to move the Fed funds rate higher this week.
Yeah, there's no way they're doing that.
So we see that as a kind of it's definitely a recessionary environment that we're in, and I think it'll be there for quite some time.
Yeah,
the mortgage rates should follow suit as things return to normal from an everyday living standpoint.
Right. But yeah, it's going to take more time than it took to shut this thing down. It's going to take to get this thing back up and running. There's no question.
Yeah, absolutely.
That. We hope that. I mean, we've never experienced anything like this, so we really don't even know. Everybody is speculating on what actually is going to happen. I truly don't think that the underlying real estate market is going to collapse. I think that this recession will be in certain sectors, and I don't think real estate's one of them. I do think that some of the investment properties like you're talking about, especially with the forbearance, because I don't think people understand what that means. I think people think that's, I just don't have to pay my mortgage. when they get the big forbearance bill, whenever the forbearance is over, unless they have one that goes on the back of their mortgage, that's going to come as quite a little shock to the system that they actually have to make those payments.
Yeah, and it's a little bit confusing at times as well, because servicers or banks or lenders have their own set of guidelines as it relates to forbearance. One thing in general I would say in regards to forbearance is, A, it's not forgiveness. It is kicking the can down the beach to a degree, whether it's added to your principal loan balance at the end, or whether you're put on a payment plan, and you pay that off over 6 or 12 months, or you take the temporary 90-day forbearance and then you pay 4 months of that, those payments in arrears on the 4th month, or the 90 days is up.
Right.
So what I understand more recently on the guidelines from Fannie and Freddie on forbearance is, if you take that 90-day forbearance option and you cannot prove the hardship to go on a payment plan, then you really have to come up with that 4-month bill, or they will start, hitting your credit and foreclosure process. Now,
yeah, I do think I agree with you. I think there are a lot of people who are, as proven by these large companies that took the PPP money and other things like that. I think there's a lot of people who are grabbing money and grabbing onto things because they think there's no detriment to them, and I don't think people have really thought that through entirely. I also believe, and I'm interested to get your opinion on this, but I tend to think that people who don't take those and pay as they are supposed to pay are going to be rewarded for that with local regional banks, if they have loans with them, and also just in the ability to get mortgages moving forward. I can't imagine that wouldn't be the case. What do you think about that?
Well, I think, obviously paying your mortgage on time every month keeps your credit rating intact, right? So there's no risk to that. Whereas with forbearance, if you run the risk of maybe not being able to pay, you run the risk of, not proving a hardship, or not going on a payment plan, or at some point or other, without making up that difference of forbearance, the risk is there that you might have your credit bruised, or have something hit your credit as a derogatory.
Right.
So I think as a reward, I'm not quite sure they're going to give a reward to someone for paying their mortgages every month, but I will tell you that there's a guarantee there that you're not going to have hurt your credit profile.
I say that because here we are in the middle of a crisis, and I have a couple of banks that are begging me to go buy apartment complexes because they want to give me money. And I don't think that applies necessarily to most. I don't think if all of my mortgages that I had with those banks I was asking for massive forbearance or restructuring my loans, I don't think that they would be so generous, or they would be reaching out to me necessarily to try to help me find properties and help me acquire more assets if I were constantly calling them and trying to restructure my loans.
Yeah, I'm on that's the larger level commercial world that I don't really have a lot of experience in, other than unless it's a Fannie or Freddie backed commercial loan, that's guaranteed by them on the commercial side. But most commercial loans and most commercial lenders are lending portfolio money. So those banks would make their own decisions on forbearance and whatnot. Right. But I have a limited knowledge of the commercial world. So
let's talk about another question we get a lot, Joe, which is, should I do a 15-year loan or should I do a 30-year loan? Pricing is obviously different. There was a really big discussion on a Facebook post because a guy mentioned that, why would you do a 30-year loan if you can do a 20-year? They can close quicker and the fees are lower, and you can get this at your local bank rather than going through a broker that costs more money and whatever. And I'll tell you in a minute what I took away from this, but I'm interested to hear what your thoughts are between a 15 and a 30-year note, and why you would do one over the other.
Well, as it relates to investment properties, I guess it just depends on your strategy. Are you interested in maximizing your ROI each month so you can save that to purchase another property? Or on the 15-year amortization, are you interested in paying that property off as soon as possible, or having the tenant occupancy pay that property off as soon as possible so that you start to reap the full rental income each month?
Right.
Particularly as you move it more into the retirement stage and you're looking at that passive income. One option over the other, it really is a personal choice, I believe, for the investor on how they want to manage their portfolio and how they want to structure and strategize around that. Most of our borrowers will do a 30-year fixed rate and maximize their monthly ROI. Most of them look at that as a long-term tax benefit. They get to write off that interest on their income taxes every year for the longer period of time. So, there's an income tax play there as well for the 30-year fixed over the 15. Sometimes the 15-year fixed, I don't know if your conversation was limited to investor properties or if it related to primary residences too, but
it was all investment.
Sometimes the 15-year fixed doesn't have the same credit overlays or credit price adjustments that a 30-year fixed might have. So what I mean by that is, you may not get a credit score adjustment to your rate with a lower credit score in a 15-year fixed, or you may not get a pricing adjustment to your 15-year fixed that you will on a 30-year based on the down payment.
Gotcha.
So sometimes the 15-year fixed is a little bit more forgiving in terms of pricing, and that's why you see those better rates. But they're also understanding that there's less risk there, being that it'll be paid off sooner. So. But I think personally, it's just an individual investor's strategy on how they want to maximize or manage their ROI.
I 100% agree. And I tell people this all the time. There's a bunch of people out there that try to suggest that investing is a one-size-fits-all thing as well. And it's not. All of the asset classes have their own unique characteristics, pros and cons. And it's the same in the mortgage world, right? And you save money by getting a 15-year note. That's just there's no other way to say it. You're going to save money. It's impossible. Even if you take the 30-year and you make extra payments with your cash flow, you're still going to be a few months apart. It's not crazy, but you'll be a few months apart, which is going to cost you a little bit more money. I've been through the crazy cycle that both of us went through. Taught me that having options is not a bad thing, and that's why I like 30-year because if I need to lower my rent for whatever reason so that I can get occupancy and someone else can't, I may still cash flow where a 15-year mortgage may be negative.
Well,
and I like
a great point.
If I want to pay it off early, I can still pay it off early. I can still make extra payments, but there's no flexibility with the 15-year loan.
Well, it's all about the obligation, right? So it's all about the monthly obligation. So the 15-year fixed, that obligation is set, regardless of vacancy factors, tenancy, whatever the cases may be. But with the 30-year fix, it's about the flexibility of, yes, there's no prepayment penalty on either option. But with the 30-year fixed rate, you can make those additional principal reductions. You can manage that principal dollar amount on your loan, but you're not obligated to do that. So in the case of, let's say, COVID and, a tenant not paying for 30, 60, 90 days, you have the ability, if you're normally paying extra principal, not to do so and meet your minimum mortgage payment, protect your credit profile, and have that flexibility. So it's more about flexibility there to do more with that ROI, as opposed to the hard and fast obligation of the 15-year fixed payment that you set it and forget it there, So
yeah, and I would much rather pay the few months more of interest, and if my goal is to pay it off early, to have the flexibility in crazy times that nobody actually like this that nobody is thinking of, to have the option, I think is really, really important.
Yeah, it's flexibility.
Yeah, man, this has been really, really good. So Joe, we've, in light of full disclosure, you do a lot of loans for us, and
thank you.
I'm happy to let everybody know that everything we talked about today is really, really important. Having someone who can actually close loans in a timely manner and do it in in a very systematic way where I don't ever have to worry if client A and client B are getting the same experience. They get the same experience, which is nice because they're going to get the same experience on our side. It's nice to be able to have a really nice systematic experience on the other side. So if people are out there listening to this and they're getting investor loans, they're not having the same experience that we talked about, and they want to reach out to you and your team, how do they find you, man? How's the best way to get a hold of you?
Well, you could just call us directly. You can Google JM Lens, so Joe and Maggie Lens. It's just our brand name within Cross Country Mortgage. So you'll find us on Facebook. You'll find us on LinkedIn.
You can shoot me an email. Guys, shoot me an email at info@rpcinvest.com. info@rpcinvest.com. Right. I'll get a number from Joe and we'll put it in the show notes so that you guys can reach out to them directly if you want. But you can just drop me an email and I'll happily give you their contact information for sure. They are anybody who's made it through the crash and been able to prosper like you guys have, man. It's a small club and there's an invisible badge that anybody who made it through that mess. Yeah. There's going to be there's a second ribbon you get for COVID-19. We'll see what happens with the COVID-19 ribbon. Any final words for everybody, Joe, before we part?
Yeah, I would just encourage your audience, your folks that are interested in investing in properties to, go for it. Don't sit on the sidelines. The sooner you can get involved, the sooner you can make the commitment to building your real estate portfolio and diversifying your investments. I think don't be afraid to do that. Working with us, we're going to set the expectation, like you said, properly with everybody in terms of our closing, execution rates, and fees. So we do encourage folks to go for it, and start your building your real estate portfolio. We want to be your lender partner as you grow your portfolio, whether you're a novice buying your first home or whether you're a seasoned investor maximizing up to 10 finance properties with Fannie Mae and Freddie Mac. So, we're happy to be your lending partner in growing your business and your portfolio.
Joe, really appreciate the time, man. This was a wealth of knowledge. I think everybody's been well fed. Thank you for your time today. Everybody, if you need a mortgage, reach out to Joe and his team. They are fantastic. They've served our clients really, really well. If you like the show, give us a thumbs up. We really would appreciate, you write us a review. We share this with all of your friends. Throw it up on Facebook and whatever other social platform you use. Share it all around the world and get this out there. So we appreciate you guys. Till next time.
Thank you very much.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.